The Secure Act was put into law in 2020, and this Secure Act really changed the estate planning landscape forever. Under previous rules, when you inherited a retirement account, you were able to stretch required minimum distributions across the rest of your life. Now, because of the Secure Act, this stretch rule was replaced with something called the 10-year distribution rule. Now, this 10-year distribution rule essentially mandates that you would completely exhaust that account within a 10-year period. So rather than be able to stretch that tax liability across your life, you now have 10 years to use up that given inherited IRA account. Now, in this video today, we're going to be talking about a confusing detail around the Secure Act and why the often quoted 10-year distribution rule is actually an 11-year distribution rule. So let's go ahead and get into it. Now, the Secure Act created three different classes of beneficiaries. The first class, called a eligible designated beneficiary, still has the capability of using the stretch rule. This would be minor children, your spouse, a chronically ill heir, or an heir that is not more than 10 years younger. Now, outside of your spouse, the most common beneficiary class is going to be a designated beneficiary. Now, the designated beneficiary is subject to this 10-year distribution rule. Now, the reason this is the most common beneficiary class is because all non-spouses that don't fit the description of that eligible designated beneficiary class are in this designated beneficiary class, meaning, again, they're subject to that 10-year rule. Now, this 10-year distribution rule has some different details that differ from the stretch rules. Now, again, with the stretch rules, you had a required minimum distribution each and every year, but you were able to spread that required minimum distribution, or those RMDs, across your given lifetime. And so you had to take one each and every year, but it would be a smaller distribution because, again, it was spread across your lifetime. Now, the 10-year distribution rule, the Secure Act, completely changes this. You will no longer have a RMD in any given year, but you have to completely exhaust your inherited retirement account within the 10-year stretch, thus the 10-year distribution rule. And so you have quite a bit of control over how you take these given distributions. You could take equal distributions throughout this entire period. You could leave all of the distributions until one given year and take that all as one large lump sum. Now, it's important to note that the same RMD penalties that apply to your individual retirement accounts still apply to inherited IRAs. So let's say that you inherited a $100,000 traditional inherited IRA. And let's say for whatever reason you didn't take any distributions through this 10-year period. And so you ended this 10-year distribution period without taking any given RMDs. Well, the RMD non-compliance penalty is 50%. It's one of the largest penalties within the IRS code. So in that specific situation, that person would owe a $50,000 non-compliance penalty because they will owe that penalty in the amount that is still left in that given inherited IRA at the end of that 10-year period. So we want to make sure we're fully understanding the rules around these given inherited distributions. Also, we want to make sure that we're optimizing the situation for our retirement. Sometimes that will mean equal distributions throughout that entire 10 years. Sometimes that'll mean because of various tax planning hurdles, like let's say trying to earn an ACA subsidy. By reporting a low income, we may forego a given RMD in any given year. Again, we just need to exhaust that full account within that 10-year period. Now, with the passing of the 10-year distribution rule, the time frame in which you are supposed to take those required minimum distributions has shortened greatly, thus leading to required higher taxes because of it. Again, ideally, the longer that we have to spread out a tax liability, the less we will pay in taxes versus taking larger distributions through a shorter period of time. And so we can see this on the screen right here. This is a chart that basically shows the payout period under the old stretch rules in light blue here. And then we see the payout period underneath the Secure Act, the 10-year distribution rule. And let's say that we're 56 years old. Under the old rules, we would have essentially 30 years where we could stretch out those given RMDs and take smaller RMDs at any given stretch. Now, because of this Secure Act rule, no matter what age you inherit that given account, you have 10 years to fully distribute that inherited IRA. And so in this given situation, inheriting at 56, this person essentially has 20 less years where they can stretch out that given tax liability, thus leading to more taxes, really any way that you slice it. So the 10-year distribution rule is often the quoted rule. You've probably seen in a few of our videos that often refer to this as a 10-year distribution rule, just to make sure that we don't lead to any given confusion. But the 10-year distribution rule is actually 11 years long. Here's why. The 10-year distribution period does not start until the year after you've inherited that IRA. So typically when we're inheriting an IRA, we're inheriting it at some point mid-year. Okay, whether that's we have a family member that passes away and we receive that inheritance in February, or we receive it in October, sometime throughout the year. Well, again, that 10-year period doesn't start until the year after, that tax calendar year after we inherit that IRA. And so let's go through an example and see exactly how this works. So let's say that this person inherits an IRA in June. They had a family member that passed away and they finally received that inherited IRA June 13th, let's say. Now, in terms of calendar years, we technically won't have 11 full calendar years. But again, in tax planning and financial planning, that really doesn't matter because it's not the calendar years that we care about, it's the tax years. And every tax year obviously ends December 31st. And so we're able to take distributions. If we inherit an IRA mid-year, we're able to take a distribution in that year and essentially add an additional tax year to this RMD period. And so, for instance, in this example, this person inherits an IRA June 13th. They can take a distribution in that first year when they inherit that IRA. They can then take 10 more distributions for that 10-year distribution rule. And so essentially they're getting 11 tax years worth of distribution. Now, depending on exactly when you inherit a given account, you may not effectively have the time to take a distribution. Let's say that you inherit an account December 31st. Well, it might be very difficult to take a distribution in that last given day and have that still be on that tax calendar year. So effectively, you may not have that full stretch. But for most situations, when we have somebody passing away at some point in the year, if we have enough time to take a distribution before the end of the year, we can have a distribution still count for that first year. And thus, the 10-year distribution rule turns into the 11-year distribution rule. And so great, most people will have one more year that they can add into that 10-year distribution rule. But what is the most effective distribution strategy for your specific situation under the Secure Act rules? Well, this is going to vary widely because most situations vary widely. Again, we should be focusing on the tax rate. And if we think about the tax rate just intuitively with the normal tax brackets, again, it would lead to spreading those distributions out equally amongst those 11 years. But we know that there are a few more layers to any given retirement decision. Let's say that you're looking at earning an ACA subsidy, and thus you want to report a low income, and you just inherited a traditional IRA. Well, we may not want to take large distributions from that traditional IRA because it's forcing us to report a higher income, thus losing a subsidy. And so this can lead to more of a staggered approach or more of an off and on type of distribution strategy. There also may be a situation where we don't want to take a given inherited IRA RMD because we're performing a Roth conversion strategy and we're looking to convert from our Roth IRAs to save on RMDs down the road. Well, that might lead to us, again, delaying those distributions from that given inherited IRA. It also, though, can be a fairly wise strategy if you're performing Roth conversions to not perform a full Roth conversion and then leave more room for you to take a distribution from that inherited IRA and use that inherited IRA distribution to pay the taxes on that larger conversion. At the end of the day, we can't perform a Roth conversion from that inherited IRA, but we can take it as a distribution and use it inside of our Roth conversion strategy. But as we can see, through the 11 years that we can end up taking that distribution, optimizing your given distribution strategy is very important. Now, this is something that we have tax specialists on our team here at Safeguard Wealth Management that can help guide you through and help optimize your given distribution strategy under this Secure Act rule. So if that's something that you're interested in, the description below, we have a link to our website where you can fill out our contact form. Hopefully this video was informational and gave you a little bit more of an understanding on how inherited IRAs are handled and how RMDs from inherited IRAs can be optimized. Always remember that you don't need more money. You need a better plan. If you like this video, please hit the like button below. It will help other retirees just like yourself find this video, hopefully gain value from this video, as well as hit the subscribe button. We release videos on a weekly basis along concepts just like this. Thanks for watching. We look forward to seeing you in the next video.